Not every fair value gap is created equal. Smart money only cares about the gaps they left behind when they're moving the market with real volume. If you trade every tiny imbalance you see, you'll get stopped out often. Trade the ones with structure, displacement, and timing behind them. We'll guide you through 5 simple steps to identify the ideal fair value gap for entering a trade. Step 1. Displacement. Displacement refers to a strong, one-sided price move caused by big players, smart money, entering the market. It's not random. It shows real strength and commitment from institutions. You'll notice this move through large candles with big bodies and small or no wicks. These candles often break market structure or shift the trend, and they usually appear away from liquidity areas. This type of move is what creates a fair value gap. When you see a displacement, it's a sign that smart money is entering trades. The imbalance in price shows urgency and inefficient movement. The fair value gap zone becomes an area to look for retracement entries. Traders usually wait for the price to retrace into the fair value gap after the strong move. When it does, they expect the price to continue moving in the same direction as the original displacement. In short, a true fair value gap comes from strong, one-directional movement, not just any small gap or imbalance.
Fair value gaps work best when they form within meaningful market structures, not just anywhere on the chart. A fair value gap that appears randomly often gets filled quickly or loses relevance. But when a gap forms as part of a structural event, like a market structure shift or break of structure, it usually carries more weight and higher probability. These fair value gaps show where smart money has been active, creating real imbalances that price tends to respect. For example, a fair value gap that forms during a market structure shift often marks the origin of a reversal, while one that appears after a break of structure commonly acts as a continuation zone. Even setups that combine fair value gaps with liquidity sweeps or occur inside accumulation and distribution phases tend to be more reliable because they align with the underlying structure and order flow. In short, the effectiveness of any fair value gap depends less on the gap itself and more on the story it tells within markets.
Let's talk about how price actually reacts when it comes back to a fair value gap. When price returns to a fair value gap, the speed and structure of that return tell you a lot about what's likely to happen next. If the move back into the gap is slow and controlled, with smaller candles, overlapping bodies, and reduced momentum, that usually means it's a corrective move. In other words, the market is simply retracing to rebalance that imbalance, and that's often where you'll see a clean reaction, or even a full reversal. The ideal reaction usually starts with a clear sign of rejection. You might see a candle with a long wick rejecting the zone, a sudden color change, for example, bullish to bearish, or a shift in market structure on a lower time frame. Those are the moments when the market is showing you that the fair value gap is being respected, that price is finding efficiency again. But if price charges back into the fair value gap aggressively, big-bodied candles, little to no pullback, breaking straight through the zone, that's your warning. It usually means the imbalance was already mitigated before, or that there's still strong momentum in that direction, so the fair value gap probably won't hold.
Premium and discount. Before we talk about the validity of a fair value gap, we need to understand what premium and discount actually mean. When we draw a range, for example, from a swing low to a swing high, the midpoint of that range is called the equilibrium. Everything above that midpoint is the premium zone, and everything below it is the discount zone. Now, think about it like this. In a bullish market, we want to buy at a discount, not at a premium. So, if a fair value gap forms inside the discount zone, that imbalance has a higher chance of being respected, because that's where smart money looks for long entries. But if that same fair value gap appears in the premium zone, it's less likely to hold for a long position. Price might use it just as liquidity before moving lower. The opposite applies in a bearish scenario. Fair value gaps forming in premium zones are usually stronger for shorts, while those in discount zones tend to get invalidated more easily. So, the premium and discount context basically tells us which fair value gaps are worth paying attention to, and which ones are just low-quality setups.
You know, a lot of traders get excited when they see a fair value gap forming during big news events, but those gaps don't really mean much most of the time. What really matters is when a fair value gap forms within the market structure, not just because of temporary volatility. A news event can create random imbalances, but they often get filled quickly and don't actually show a true displacement in price. So instead of chasing every gap that appears during news, focus on the ones that are part of a clear structural move, a real shift in market direction. That's where the high probability setups usually are.